You ever wonder what really separates the world's greatest investors, the Warren Buffetts, the Ray Dalios, from everybody else? It's not just luck, and it's definitely not about timing the market perfectly. It really all comes down to their mindset and their discipline. So today, we're going to break down the 5 essential traits that all legendary investors share.
So what is their secret, right? How do they consistently outperform year after year after year? Is it some super complex formula they're hiding? Well, the answer is actually a lot simpler and way more powerful than you might think. It's not about what they know, it's all about how they think.
And right here, this is the fundamental gap. This is where it all splits. Amateurs, they're obsessed with timing the market. They get totally swept up in that emotional roller coaster of fear and greed, and they act with impatience. But the masters, they focus on their mindset, they operate with unshakable discipline, and they use patience as their ultimate weapon. This difference, well, it's the foundation for everything.
Okay, so let's dive into the first trait, the power of patience. Honestly, this might be the single biggest differentiator there is. While most of us are checking our phones for the daily stock moves, the legends are thinking in decades, not days. Their whole time horizon is just fundamentally different.
I mean, just take a look at Warren Buffett's investment in Coca-Cola. He's held that stock for over 35 years. He doesn't see it as some temporary trade. He literally calls it a forever holding. Now that is the kind of long-term conviction we're talking about.
As Buffett himself famously said, the stock market is a device for transferring money from the impatient to the patient. You see, patience isn't just passive waiting. It is an active strategy. It's the very mechanism that moves wealth from those who just can't wait to those who can. And that leads us right into the second trait. The masters, they obsess over understanding systems, not making these flashy predictions. They don't have a crystal ball. Nope. Instead, they do the really hard work to understand how money moves, how economies actually function, and maybe most importantly, how people react. This whole process, it's not about being right all the time. It's about getting less wrong over time. Ray Dalio is famous for this. He journals every single decision, the why behind it, and then he ruthlessly reviews his mistakes. What this does is it creates this powerful feedback loop that's constantly refining his investing principles.
Dalio's whole philosophy is crystal clear. He's not trying to guess what's going to happen next week or next month. He's building a robust framework of principles that can withstand whatever the future throws at it. The goal isn't prophecy, it's resilience.
So trait number 3 is a total reframing of what an investor really does. The best ones, they aren't gamblers looking for that one big score. They are methodical risk engineers, and their number one priority above all else is protecting their capital.
A risk engineer understands this painful truth that's rooted in our own psychology. We hate losing more than we love winning. A 50% loss requires a 100% gain just to get back to even. That's just brutal math. And the pain of that loss feels about twice as bad as the pleasure of a gain. So they design portfolios to survive the inevitable storms, not just thrive when it's sunny.
As the famous George Soros put it, it's not about being right or wrong. It's about how much money you make when you're right and how much you lose when you're wrong. The whole game is about making sure your wins are huge and your losses are small and manageable. If you get that right, you come out way, way ahead. That's the core of risk engineering.
And these are the tools of the trade. It's not magic, it's just mechanics. They use careful position sizing so that no single loss can ever wipe them out. They diversify across all sorts of different assets. And they use hedging, which, is kind of like buying insurance for your investments to protect against the downside. They are actively, constantly building their defense. All right, now we're going to move from the technical stuff to the psychological with our final 2 traits. Because, look, after you've built a solid system and engineered for risk, the absolute hardest part is actually sticking to it. This is all about mastering the psychology of the market and, maybe more importantly, mastering your own. So, the 4th trait is that all great investors are contrarians at heart. They actively fight against that powerful gravitational pull of the herd mentality. They don't just follow the crowd into the latest hot trend. In fact, they're most comfortable when they're being misunderstood, because that's often when they see something the crowd is completely missing.
When market emotion, whether it's fear or greed, is at an absolute extreme, that is precisely when the contrarian makes their move. They lean against that overwhelming sentiment, buying when the crowd is panicking, and selling when the crowd is euphoric.
And this leads us to maybe the most iconic piece of investing advice ever, delivered by Buffett right in the middle of the 2008 financial crisis. This isn't just some clever phrase. It is the operating manual for a contrarian. It's a direct call to action.
And our final trait, this is the one that ties everything together: emotional mastery. You can have the best strategy in the entire world, but if you can't control your own emotions, it's completely worthless. Legendary investors master their internal world first.
Ultimately, so much of it just boils down to these two incredibly powerful emotions: fear and greed. They are the twin engines that drive every single boom and bust cycle in history. A master investor doesn't eliminate these feelings, that's impossible. They just recognize them and refuse to let them dictate their actions.
As the legend Peter Lynch put it so simply, the real key is not to get scared out of your stocks. Think about it. The biggest mistakes people make often aren't buying the wrong company, but selling a great one during a temporary downturn. Emotional stability, that is your greatest ally when things get choppy.
So let's bring it all together. This, right here, is the DNA of lasting wealth. It's not just one trick. It's a combination of these 5 pillars: thinking long-term, building deep understanding, controlling your risk, having independent judgment, and mastering your emotions. Every single great investor has built their success on this very foundation.
And that leaves us with this final thought. In investing, the real battlefield isn't the stock market, it's the 6 inches between your ears. Your own mind can be your most powerful asset, or it can be your own worst enemy, your greatest liability. The choice, ultimately, is yours.